Is your business failing because you miss great opportunities? Smart business owners understand what struggling ones miss. Debt isn't a burden, it's a competitive weapon. Strategic borrowing multiplies your reach, letting you move while competitors wait. It keeps your cash reserves intact for emergencies and opportunities, giving you options when others have none. Debt proves your business works. Banks don't lend to failures. It preserves your ownership completely, while fueling growth that would take years to self-fund. Financing forces the financial discipline that separates professional operations from hobby businesses. When you eventually sell, buyers pay premium multiples for companies that have proven they can leverage capital successfully. Here is an example how debt benefits your business. Here's what most valuation models miss. Unused borrowing capacity has value independent of current operations. In valuation terms, many call it a redundant asset. When you have an established $1 million line of credit with $800,000 available, you own something competitors don't: the ability to act decisively when opportunities appear. This optionality manifests in multiple ways. Your competitor's largest client gets frustrated and decides to switch. They want to see you can handle 40% revenue growth without operational hiccups. The owner with $800,000 in accessible capital wins that client. The owner who would need to scramble for emergency financing loses it. That single client acquisition might represent $2 million in enterprise value on a 5 times revenue multiple. A key supplier suddenly requires 50% deposits instead of net 30 terms. Without accessible capital, you're negotiating from weakness, potentially losing preferential pricing or allocation. With dry powder, you're indifferent. You simply adjust payment terms and maintain your supply chain advantage. In every downturn, assets become available at distressed prices. Real estate, equipment, even entire competitive businesses hit the market. The buyer with prearranged financing closes deals while others are still pitching banks in a recessionary market. A $300,000 equipment purchase during the 2022 downturn might have cost $600,000 in 2019 or 2024. That's $300,000 in instant value creation, plus the strategic advantage of expanded capacity. Sophisticated buyers price this optionality into their offers. A business with $2 million in established credit facilities might command a 10 to 15% premium over an identical business operating cash only, simply because the infrastructure for growth and risk management already exists. Go search what weighted average cost of capital is and come back. Say you need $2 million to expand your business. An investor will provide $2 million but wants 20% return. Your cost of capital is 20%. If you have $1 million in profit, then your company is worth $5 million. However, if the bank will give you $1 million at 8% and you get the other million for 20%, your cost of capital is now 14%. 8% and 20% averages 14%. Therefore, the new multiplier is 7.14x. The value of your business just went from $5 million at 5x to over $7 million just by getting bank approval. You have not even borrowed anything yet. That's how it works. Rewatch this if I went too fast, as this concept is very important. The benefits don't end with increasing your valuation. If you want to partner with an valuation and financing expert, contact a SaferWealth advisor today. Don't miss any more opportunities. SaferWealth.com. You can't shoot a gun without dry powder.